For more than 2 decades, we've been educating our listeners about financial topics that are most important to you. Do you have enough money to retire? How will you keep from running out of money? What's your plan for managing market risk? What about taxes, inflation, and healthcare? Each week, we talk with an advisor at Lucia Capital Group about these issues and more. This is Managing Your Financial Future.
Well, thank you very large. Managing Your Financial Future. Johnny Dean here with you, host of this extravaganza. Hey, here's a cautionary phrase for you. Now, I think this is one that will serve everyone well when they're meeting with a financial advisor. The phrase is this: if something doesn't make sense to you, keep asking questions until it does. You know, when you meet with a financial advisor, you have to have a certain amount of trust in that person. But at the same time, it's always a good idea to be on the lookout for anything that doesn't necessarily add up. Now, Professor Rick Plum, certified financial planner professional and accredited wealth management advisor, as they have me say every time, I think you would agree with that statement. You want an informed client. I can't imagine that you would disagree with that.
No, I agree. They may not be able to. I mean, they don't have the experience that a good advisor has, but they've got to at least grasp concepts of reality to some degree. And you should know what is going on and what you're buying.
Well, yeah. And you know, and I would liken this to when I bring my car in, you know, when I used to bring it to the mechanic. I don't know anything about cars, but I know just a little. So if they're being ridiculous, I know how to call them on it. But if they tell me something, I almost have to trust them. And I can't compare it directly to financial advice, but in some ways I can. So I want to bring this up. You found this article about NASCAR star Kyle Busch. I can't believe I've heard of this guy. I mean, I haven't.
Well, he's one of the more famous NASCAR drivers. And these NASCAR drivers, especially the high-end ones like this, they make very good money.
Well, they must make a lot of money.
Make a good living.
Well, according to this article, Kyle Busch says he lost $10.4 million in just 16 months through an investment gone wrong. Specifically, they said, according to the article, a strategy involving something called Indexed Universal Life. That's IUL. It's an insurance policy, and it was recommended. I guess the firm is now defunct, whatever it was. I'm not going to name it. And the owner was later convicted of fraud. But the loss wasn't due to theft. It was due to what they said, I guess, was a high commission structure with some risk to it that Kyle Busch didn't fully understand. And he admitted that he didn't ask enough questions and just trusted his longtime advisor, only to later discover that the strategy, apparently, and I don't know how, had drained his wealth without delivering the promised benefits. So this was the article, and this got me thinking about this. So what I want to focus on here with you, Rick, I mean, in addition to just quickly explaining what this IUL, Index Universal Life, is, because there are other policies as well that can work within a financial plan. But I want to focus on the idea that this person really had no idea what he was getting into. When you put $10+ million into something, but you're not sure what it is, then I think we need to address that.
Now, he didn't put 10 in. He only put 5 in. Let's be fair.
You're right.
But he did put $1 million a year for 5 years.
You're right.
I don't know where the $10 million loss came from, the way that the article described it. But still, it's a big thing. It's a big number, bigger than what most people, and you're saying, well, why are we even talking about somebody who's investing $5 million? Because that's not reality for the 99% of the people that are listening to us. But it is something that is pitched a lot to people that don't have 5 million, 10 million, to almost normal people. Now, if there was ever a candidate for this type of product done correctly, Kyle Busch would have been that candidate. A young, healthy, high income earner that has the ability to set aside large amounts of cash for a relatively short period of time and then wait it out for another 15, 20 years. He's a perfect candidate for this type of investment, high income tax bracket, high cash flow. This is the guy that should be looking at this kind of product. Unfortunately, he fell into some unscrupulous people here that screwed him over. And
If you would, I'm sorry, explain kind of what this product is. I will not spend the whole time on this. I'm going to be very quick with this because we have a larger theme. But if you would explain what this is and what you think maybe went wrong in this case.
Well, let's talk about maybe somebody who doesn't make as much as Mr. Bush does, but just take a very high net worth individual or high cash flow individual, younger, 30s, maybe 40s, with a lot of discretionary cash and a very high income tax bracket. Tax-free investing becomes a very favorable type of way to look at things. And so a life insurance policy, a cash value life insurance policy, can be designed to create a lot of cash-free buildup or cash-deferred buildup inside the policy, and then at a later date start withdrawing that buildup in a tax-efficient, tax-free manner. And so you don't get the tax deduction up front. So when Mr. Bush was putting the $1 million a year in up front, he wasn't getting a tax deduction, but he was looking in what he expected was by the time he was 52 years old, which was, he was only in his mid-30s when he did this. So basically almost 20 years later, he was going to be able to take out $800,000 a year tax-free for the rest of his life. We don't have to use them. Maybe it's somebody who's putting $100,000 away and is going to get $80,000 a year for the rest of their life. And then when they die, there's a little bit of death benefit left over. And that distribution over those 30 years of distribution from 52 to 82 to 92, that can potentially all be tax-free. If done correctly, this can be a very nice supplement to the other things that you're doing in your life. It's not for everything. So these can work very well. The idea is that you put in cash into this cash value policy way in excess of what is necessary to maintain the death benefit, and that extra cash goes in and grows. And because it's life insurance, it's tax sheltered. We get that tax sheltering from life insurance as long as we live up to the rules that Congress has set forth for life insurance. And so as long as we live with the rules, it works really well. One of the rules, though, is we have to have a death benefit. A certain amount of death benefit. It doesn't have to be a lot. It just has to be a certain amount of death benefit over what the projected cash value is. What I think happened in this situation was they ran the death benefit very high. And somebody said, well, if I'm buying life insurance, don't I want a really high death benefit? Not in this case. In this case, we're not using the insurance necessarily for the death benefit. We're using it for the tax advantage of the cash buildup. And we can't have really good cash buildup with low fees and a very high death benefit. The death benefit costs money internally. So the higher the death benefit, the higher the expenses, and also the higher the commission. But when we're designing one of these policies for cash, for retirement planning needs, for that nature, not for the death benefit, we want to run the death benefit as low as the IRS, Congress, has allowed us to run it, thereby limiting the internal costs, limiting the drag on that cash value buildup. And so we want to run the death benefit as low as possible. Now, the problem for some of the people selling these things is when you run the death benefit down lower, you cut the commissions. I mean, because the commission is based on basically the death benefit. It's based on a target premium. It's a bunch of BS, but the higher the death benefit, the higher the commission. So you get paid on the premium required for the death benefit, and then the extra money you're putting in each month, each year, you get a little spiff on, but nowhere near the commission of a life insurance commission. And so the only way this thing could have blown up as fast as it did was that they ran a really, really high death benefit, which in his case, the guy races cars at 200 miles an hour. There may be a reason for a death benefit, but I wouldn't buy it this way. This was designed for cash value. So there's different uses of life insurance, but it can work. Indexed universal life gives you a cash flow or cash value increase based on the stock market or some index that you're dealing with. Now, it's a somewhat complicated, not overly complicated, but you just have to understand what's going on, and you want to run the death benefit low, and you want a policy with good cap rates so you get good rates of return. And the reality is he bought this 5 years ago, and he should have had decent returns because the market, 2022 wasn't all that great, and a little bit of time in early 2025 wasn't all that great, but most of the time we've had pretty good returns in the market.
So he
should have done okay.
Yeah, well, it sounds to me, and I guess to you, it sounds to me like he thought he was buying this not for the death benefit, but for the cash the cash flow.
Oh, definitely. He was buying this for the cash.
Going to come. Now, we don't know what happened, but if you had to guess, it sounds like you're saying that
the only way this thing could have fallen. Yeah, the only way this thing could have fallen apart the way that he said it fell apart was that the internal expenses were way too high. And the only way the internal expenses were that high were that the death benefit was really high. Because all the other internal expenses are a function of the death benefit.
Okay, so this is what we're guessing. And again, we don't know. The numbers are
structured.
The numbers, as you were doing the math, we still have questions, but that's not really kind of the point. The point is more, for people who are listening to this, is that Kyle Busch, when he bought this, thought he was buying something and either didn't ask the right questions or, in fact, let me ask you this. Do you think this is the case of him not asking the right questions, or is it more likely the person who sold him on this investment was being misleading and evasive, or is it a combination? I mean, I know we don't have all the facts, but just what's your basic guess?
It probably has a little bit to do with both, but I think a lot of it falls on the person selling it, and I believe that it was not well designed. It was mislabeled, misleading, and it was not explained that, unfortunately, when you run these things with the higher death benefit, with the higher expenses, the line between success and failure is razor thin. Mm-hmm. If you hit certain marks, this thing's going to work great. If you just miss those marks by a hair, you're going to have problems with the policy. And so that's one thing that I think needs to be more explained. So I think a lot of this falls on the person selling it. I do believe that it was misdesigned. It was not done well. If it falls apart this quick after 6 years, let alone after 50, 60 years, then it was not well designed to begin with. It was designed with one purpose, and that was to make a lot of money for the person selling it.
It sure seems that way. I mean, we don't have all the facts, but just the from the view that we have.
But this thing should have worked.
Well, it should have worked if it was done correctly, as you stated at the top of the broadcast. So here's what I want to do for the benefit of people listening. Now you don't have to know what IUL is, but it helps to know that this is a product, that how it was designed. But what I want to go over with you, and I'm going to do this in the time that we have here, is maybe 4 or 5 things. Let's say 5. 5 things that I've come up with that I think a good financial advisor will do, and that I think probably didn't occur in this particular case with the Kyle Busch story. So let me run these by you, and I just want you to comment on these, Rick, because you would agree with all of them, I'm sure. The first one I want to ask that I think a good financial advisor will do, and it is no particular order, but this is important, is to clearly explain how that advisor is getting paid, whether, it's a flat fee, asset, percentage, commission, whatever it is. The client needs to know how they're getting paid. What do you think about that?
I think and this is going to rub life insurance agents the wrong way. I think it is important. And they should have explained that the portion of the premium, the portion of the contribution, the dollar amount that I'm asking you to put into the policy that is based on the death benefit, I'm going to get paid X percent. And it's a big percent, 50, 60, sometimes even higher percent. And then the amount that goes in above that. So in this particular instance, he was putting in $1 million. And the idea would be to have tried to run the death benefit down to where the actual premium for the insurance was maybe $100,000, and the rest of the $900 was going in as an extra contribution. And so I may get 80% of that $100,000 in the first year, only the first year, but then I only get 4% of the difference, the other $900, rather than base it on $900,000 of life insurance premium, where I get 80-90% of, and then only $100,000 of the 4% stuff. So it's a blended number, but unfortunately, unless you know that, it's difficult to understand. But life insurance does pay very nicely.
Yeah.
Now, I may be exaggerating. I don't know the premium structure on how he was doing this, but the only way it could work. Now, I'm not going to say that this was a problem of the life insurance company, other than they may not have regulated their advisor or their salesperson. I don't want to call them an advisor, their salesperson very well, because I know the company, and the company is a very good company. They stated who the insurance company
you're saying,
and it was a very good company. So I have no problem with the insurance company. This is all about the design and the way it was sold, and understanding, okay, I'm telling you that you can put in $1 million a year, and it's going to give you $800,000 a year when you are 52 from the lifetime over. And here's how it's going to work. And to get those marks, you need the market to basically do better than 6, 7, 8% a year. I don't know what the numbers were. They probably ran it a lot higher, that it needed to get better returns than that. But and I'm going to get paid for selling you this. I'm going to tell you right up front, but I still believe this is the best thing. Here's why it's the best thing. And I'm going to get paid a very handsome number. According to the article, the guy got paid 35% of the first year contribution. That's not bad.
Yeah.
Because that would have been a $350,000 payday for that guy.
Well, okay, so the gist of this is, though, that Kyle Busch and I won't just say him, but anybody who's buying anything, and it doesn't have to be $5 million, they need to understand how the advisor is getting paid. Who's paying you? How is it being paid? What happens? How does that affect my rate of return and all that stuff? So I think one of the first things that you should look for with a financial advisor is that they're explaining how they're going to get paid. This is very important.
Is this commission based? Is it an ongoing fee base? What's the fee base based on? Are there breakpoints in the fee? How is it paid? Is it paid in the front? Is it paid in arrears?
Yeah, all these things. It's important to do this, and don't think that if an advisor is getting paid for giving you something that it's a bad thing. It may not be, but just understand, okay? Because they're probably getting paid. You can get paid on a CD, really. I mean, there are fees in CDs. You just don't see them. So okay, so that's one. Here's another good thing that a financial advisor will do, besides explaining how they get paid, is they will start with your goals and not with a product. And you have seen this where, or at least you've heard of this, where, a client comes in and the first thing the advisor or whoever, the salesperson says, "Hey, have I got a great product for you? What's your name again?" Well,
if you're a hammer salesman, everything looks like a nail.
Exactly. Exactly.
Yeah. But in this case, the goals were in alignment. As I mentioned, this product, the way it should have been designed, was the right product. Assuming that Mr. Busch came in and said, "I want to have something that gives me a great income when I retire." And this is a potential for that. Now, great is a relative term. I don't think it was a great income. I think it was a good income. But so yes, I agree with what you're saying. You start off with, what are you trying to accomplish in life? What is it that you want this money to do for you? I mean, besides grow at 100% a year, tax-free with guarantee of principal. Okay, that's not going to happen. But what is the purpose of this money? And we'll start off that conversation with people like, you know what? Never thought of it that way before. And then they'll get down to, well, I want it to grow, but I'm worried about it losing money. Okay, let's talk about time horizon. Let's talk about all these other things. But let's talk about what your goals are. You're right. Start with the goal, the purpose, the idea of what you want to accomplish, and then fit the appropriate investment in there. If I walk onto a car dealership and they're looking at me, and they're saying, "Oh, this guy looks like he needs a sports car," and I'm coming in there thinking I want to buy a truck because I need to haul something, and they keep trying to sell me a sports car, we're not talking the same language, and it's probably not going to. If I do buy it, that's my fault, but because I didn't do what I was supposed to do. They had a product they wanted to sell me, and I ended up buying it. That's my fault. I came in there for a truck, and they sold me something else. That they said, "Oh yeah, it'll do just fine. It'll tow that 10,000-pound trailer over the hills."
Well, it's harder.
It's got 500 horsepower.
It's harder, of course. Now it's easier in that case, I think, to recognize a truck versus
right.
sports car.
But
for people who don't understand finance, it might be harder for them to understand this. Now, this Kyle Busch may have come in and said, "I want this for income. I want a large income." It sounds like that's what he thought he was getting. But you know what? If he had come in and said, "Hey, listen, I want an insurance policy that's going to pay a massive amount of, because I drive cars for a living and anything could happen. I want to make sure that this policy has a huge death benefit." They probably would have had to give them a different product. So,
they should have.
Maybe they started with the goals, but this is not, what they wanted.
Now, this one was not. This one was they may have started with the goals. No, they said, "Okay, we're going to sell you something, and you want something when you retire." But I said he's the classic example of somebody who could have looked for it. It was just he got hoodwinked.
It's
hard to know. Like you said, it's hard to know. And the reality is, when you look at this, you put in $5 million, $1 million a year for 5 years. Then you wait 17 years. Oh, C40. You wait 19 years, and then you take $800 a year out for the rest of your life. Mm-hmm. That sounds like a really, really good rate of return, doesn't it?
Well, you've done the numbers. So.
The reality is, if that happens till you're 90, and there's still some death benefit left over, let's say that there's $5 million of death benefit left over at that time, which I think might be a little high. That's only a 6% 40-year, 50-year return.
Not great.
Only. That's not guaranteed in the market today, but 6% isn't that exciting, really, if you talk about 40, 50-year returns. But if you talk about $800,000 a year, you put in 5 payments of $1 million, and you get maybe 30 or 40 payments of $800,000 a year. That sounds like, wow, I am doing incredible. When in reality, because of the time horizons involved, yes, I do it for 5 years. Then I do nothing for almost 20 years. And then I start taking money out. It's not that, I mean, it's still, I'm not saying it's a bad rate of return. And the fact that if they did it right, if it had worked, it would have been tax-free, sounds good. Mm-hmm. But it's not like earth-shaking.
Well, okay. And now, if you lived to 120, it would have, that rate of return would have gone higher. All right. So I want to make sure we get to all these. But first, explain how you're getting paid, and then start with goals, not with a product. A good financial advisor will do both of those. Here's a third thing that a good financial advisor will do, I think, is talk openly about risk and return. I don't think this happened in this particular case, because I don't think if there was a risk of him losing all of this money after however long it is, a very short period of time, they weren't having a conversation about risk and return. Why do you think it's important for an advisor to talk openly about risk and return?
Well, to understand, there's a premium for risk. You've got to expect something for risk. And so you have to understand what's going on in life, what's happening. Nothing is risk-free. Even things that have no risk to principal have risk to inflation and other things.
I think a bad advisor would be reluctant to talk about risk because return seems to be the thing that attracts people to products, And look how much you can make, even potentially make. And if they don't talk about the risks, then it just seems to me that is this is counter to what a good advisor should do. A good advisor could say, look, this could make a decent amount, but you got to understand what the risks are in this. And I just think when you're not promising unrealistic results, as maybe this particular advisor did, you're actually doing the client a disservice. You need to make sure that you aren't promising anything that's unrealistic. So that's risk and return. The fourth thing that I think a good financial advisor will do is to give you time to think before making decisions. You can't pressure somebody and say, hey,
walk out the door. I'm not going to give you this price again. You walk out the door. You will not get this opportunity. You better sign right here, because otherwise this evaporates. You don't get the special handling and delivery unless you do it right now.
Have
sign up within the next 45 seconds.
Oh, have you? Obviously, I think we're exaggerating, but I got to think that maybe at some point somebody has seen somebody doing that.
I've seen it done in the financial industry where you would say, look at the cap rate is X percent, but they could go down tomorrow. So we want to make sure we get today's cap rate. So you better sign today. Today's rates are what they are. I've seen it done in mortgages. I've seen it done in CDs and other things, fixed annuities, anything that has a stated rate that can change. You better get into it before the rates change. Those kinds of things.
Well, as true as that might be for some people, if they say, hey, listen, rates are now at 2 point something, whatever they were when they were really low, you might say, well, there's a time crunch. But I still don't want to be pressured into doing that. So even if they're... And
the good news on this particular type of policy that we were talking about, the IUL, it is not a quick thing. With the death benefit involved on this, he would have had to go through some serious medical underwriting before the insurance company took the risk on him.
Can you imagine taking a risk on a guy that's driving at 200 miles an hour?
Well, and I got to think that had an impact on the cost of the insurance too. He's not getting the same rate as a typical 35-year-old that doesn't race at 200 plus miles an hour. His insurance, that internal cost for that insurance was a lot higher.
Yeah, I don't know if we want to say the word impact either at those speeds, but
ouch.
yes, that is something that I'm sure was taken into account. But still, you do in the Kyle Busch case. Yes, I know that there was time to think about this, and he probably should have asked questions and was more.
And you asked how this could have gone so bad so quickly, and it may have been that they showed him an illustration based on a preferred healthy 35-year-old. Normal 35-year-old that doesn't race NASCAR. And then when it got underwritten and they came back and said, okay, the actual rating cost and everything is 4 times this. And they didn't rerun the illustration.
But somebody should have said something at some point. Said, "Hey, you're not getting what you're getting." So give time to think before making decisions. And then a fifth thing that I think a good financial advisor will do is I alluded to this at the top of the broadcast, is to welcome your questions and answer them. Problem is sometimes people don't know what questions to ask, and I know you've been through this too, where you might be explaining something, even if it's something like the concept of buckets and how does buckets work. It could be anything. It doesn't have to be a product, but they may not know what questions to ask. So very quickly, Rick Plum, how do you draw that out? Do you just explain ahead of time and anticipate what questions they should ask, or how does that work?
Well, we've been asked a lot of questions over the years about what we're doing. And so the idea is if somebody's not asking a lot of questions, we'll bring up questions that other people ask. Mm-hmm. Say, a lot of people will ask us about this. Oh, yeah, I hadn't thought about that. Well, and here's what's happening with that. Now, that sometimes can feel like it's been a leading question where, pushing you down a certain way because I'm bringing up the questions rather than you. But I'd rather you brought them up. But if you're not bringing them up, I'm going to try answering questions so that you have a better understanding of what's going on and the risks, because I really do want to explain the risks involved if there are any, because I don't want you to be blindsided, because I don't want you pissed off at me. I'd rather you be pissed off and never do business with me because of something I said before we ever did business than to think you understand what's going on and then get pissed off later, because then you get madder.
Well, yeah, and I know what you mean by that, because, this, again, is a relationship where everybody needs to trust everybody. You're talking about somebody's money. You're talking about their life savings in some cases, maybe all of it, maybe a portion of it. It doesn't matter. For Kyle Busch, you lose whatever he claimed he lost, 10 million, 5 million, 6 million, 16. I don't know what it was.
I'm sure it wasn't all of his money.
No.
I mean, it would have been a number, and I'm sure it didn't feel good.
But
it doesn't matter. A lot of people, we go through this, and it's not people necessarily, it's a lot of people that don't make the same kind of money, but still have a high income. Where I feel bad is when I see these being sold to people that are in the 12% income tax bracket.
Man.
And they're just being raked over the coals in these areas. And it may only be a $10,000 annual premium instead of $1 million annual premium. But it's still, that's going to have a bigger impact on that person than it did on Kyle Busch.
Well, now, how is somebody supposed to know that, though? I mean, when somebody is sitting there and they're saying, well, gee,
listen to our podcast and call us.
Well, honestly, I this is why we're talking about this today, because, unless the advisor is bringing things up like this, and honestly, I guess if you are at all financially savvy, you should have your radar up, your BS radar, and just say, it doesn't even have to be pure BS. It could just be, hey, I'm not sure that this is exactly the way you're describing it doesn't sound right. Can you please explain this further?
Well, second opinion. I mean, you do that with high-end, medical treatment.
Sure.
You get a second opinion.
Yeah, it's a good idea.
From somebody that's not affiliated with the first opinion.
Yeah, let me get you a second opinion. Hey, Bob, down the hall. Come down here. Yeah, these are things that you really got to look out for. Well, so just to wrap this up, the 5 things that a good financial advisor will do, again, is to explain how they get paid clearly. You want to make sure that's and ask those questions. They should start with goals, not with some kind of product. They shouldn't even talk products personally, I don't think, for a while, if at all, depending on what you need. You should talk openly about risk and return, give you time to think before making decisions, and then welcome your questions. And don't make you feel dumb about asking questions. There really is no dumb question, frankly, because if you have a question, it means you don't understand, and you should ask it. And the advisor should answer that. That's the kind of stuff that Professor Rick Plum and the Lucia Capital Group people talk about all the time. Whether it's Index Universal Life. We didn't get into some of these other things because there are other insurance products too, Rick, that can be used for income.
You can do that type of strategy with any cash value policy. Yeah. You can do it with anything other than term.
Well, and again, this goes back to the fact that these types of products aren't inherently good or bad. It's just they are tools that work best when the job is described, just like a lathe has a very specific type of use, and a hammer does, and just about any tool. And that's how you got to look at these things, and just make sure that whatever you're considering or whatever somebody's pitching to you is being used to get the job done. And the job is whatever your goals happen to be. Talk to any of the Lucia Capital Group advisors, 800-644-1150. That's the number at Lucia Capital Group, 800-644-1150. Go online, luciacap.com, LUCIACAP.com. There you're going to find also our downloadable guides. I should mention this more often than I do, but we do have them. Social Security Guide, Retirement Income Guide. We have a Buckets Guide and a estate planning guide, a few other things. Just type that into the search bar at the top, and it should be that free PDF that you can download and read at your leisure. Take a look at it. I really think it's I think it's helpful, and I do think it's important. Go to luciacap.com for that. Subscribe to this podcast. I'll remind you of that yet again. Apple Podcasts, Spotify. Make sure that you click the subscribe button. Don't miss a single episode, because then, hey, we'll tell you what you need to know. And I think I told you what you need to know here today. Apple Podcasts and Spotify. Professor Plum, I thank you once again. We are getting toward the end of the year, so we'll be taking a couple of weeks off, but just wanted to say thank you. And for Professor Rick Plum, certified financial planner, professional, and accredited wealth management advisor, I'm your podcast host, Johnny Dean. This has been Managing Your Financial Future. Thanks for listening. We will, of course, talk to you all again next week. The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. These materials are provided for general information and educational purposes based upon publicly available information from sources believed to be reliable. The information in these materials may change at any time and without notice, and its accuracy cannot be guaranteed. There is no guarantee that any investment strategy will meet its stated objective. All investments involve risk, including potential loss of principal. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed, and subject to potential federal and state law amendments. There's no guarantee that you will achieve the results discussed or illustrated. Indexed Universal Life, or IUL, has caps on returns and no guarantees as to the premium amounts or market returns. An IUL insurance policy may be canceled if premium payments stop. CDs are FDIC insured up to $250,000 per depositor per insured bank for each account ownership category. Fixed annuities are suitable for long-term investing, such as retirement investing. Gains from tax-deferred investments are taxable as ordinary income upon withdrawal. Guarantees are based on the claims-paying ability of the issuing company. Withdrawals made prior to age 59.5 are subject to a 10% IRS penalty tax, and surrender charges may apply. The information provided is based on current laws, which are subject to change at any time. Lucia Capital Group is not affiliated with or endorsed by the Social Security Administration or any government agency. Social Security rules can be complex. For more information about Social Security benefits, visit the SSA website at ssa.gov or call 800-772-1213 to speak with an SSA representative. Rick Plum is a registered representative with, and securities and advisory services offered through LPL Financial, a registered investment advisor and member FINRA SIPC. Any other individual or company mentioned in this podcast are not affiliated with or endorsed by Lucia Capital Group or LPL Financial. LPL Financial Insurance License number 05-18721. LPLIA Insurance License number 0B91442.